So chapter 9 is all about long-term assets. Specifically, we're going to talk about property, plant, and equipment. And then the chapter does touch up a little bit on intangible assets a little later on. But for the most part, it's very heavy on property, plant, equipment. Today, we're going to just look at the first two objectives. This is where most of the work is. So this is what we're going to be doing today. Even though there's three objectives to do after today, they're relatively brief in terms of their content. So not a huge deal, like I was telling you. All right, so what are we learning first? I love how they have the wrong thing here. Good Lord, these slides are horrible. Anyway, learning objective 1 is all about plant assets. So property, plant, and equipment, we can abbreviate it to call it a plant asset. When I was back in your days, we just used to call them fixed assets. So what are plant assets? Property, plant, and equipment have a physical substance. You can literally touch them. You can see them. They have a distinct shape and size. So whether that's a piece of land, drive-through speakers, a building, a refrigeration system, tables and chairs, computer systems, they have a physical substance. You can touch them, you can see them. It's pretty clear. They're going to be used for over a year. They're long-term assets because they're going to be used for over a year. All right. Second thing is they're used in the operation of the business. So they're not intended to sell to the customer. So customers can't come into your pizzeria, admire your pizza oven, say, hey, I'd like to buy that pizza oven from you. The answer is no, it's not for sale. I use it to make my pizzas and my sandwiches. So if I sold it to you, I wouldn't be able to have a business. So no, it's not intended for sale. We use it in the operation of the business. That's the purpose of it. Another thing that we buy these plant assets for is we know we're going to use them for a number of years until they're going to have to be replaced. So I'll go back to my pizza shop. I know my pizza oven is going to help me. It's going to provide a service to my company for a long period of time. But pizza ovens don't last forever. They have what we call a useful life to the business. That useful life might be 10 years, might be 15 years, but nonetheless, after that period of time, it's going to need to be replaced. So businesses know that. And so we know that they're going to be providing a service for a period of time. The only plant asset that lasts forever in the view of accounting is land itself. Okay. So land is always going to be there. But, everything on the land, from your parking lots to your building to your equipment, is going to eventually need to be replaced. Okay. They don't last forever. So plant assets are very, very important. They're a large part of a lot of companies' total assets. So when you look at a company like Wendy's, 73% of their total assets are simply property, plant, and equipment. Well, that makes sense if you think about a Wendy's. Usually Wendy's, they own all their buildings. So they bought the land, so they have the land. They had to put, parking lots and other things and fences on that land. They own that. They have buildings. They own that. They have lots of equipment in the buildings, both for refrigeration and cooking to make their little frosty things. They have counter space and tables and chairs and other types of equipment that they need there. All of that is plant assets for Wendy's. So yeah, it makes sense that a large part of their total assets are property, plant, and equipment. Makes perfect sense. For airlines, again, this is going to make sense because your airplanes are property, plant, and equipment. And of course, airplanes are they're good for a long time. They can last 20, 30 years. But, certainly they are a very large part of your total assets. Some businesses might not need as many property, plant, and equipment type of assets. And so it's less so. When you look at a balance sheet and you see that a company owns land or a building or equipment, it has a number on that balance sheet. How did they come to that number? They have to use something called the historical cost principle, which means that when a company buys property, plant, and equipment, they're recording it at their cost. Okay. It's not the market value that's listed on the balance sheet. It's simply the cost of that asset. Okay. Um, and so, basically speaking, that's a very important type of thing to know. How do they determine the cost of an asset when they buy land or they buy a building or they buy equipment? Well, basically, the cost is everything they need to spend to get it ready for use. And that's going to be the standard you're going to hear about a lot, ready for use. The ready for use standard is the standard we use to determine the cost of an asset. How much money do we have to spend to get it ready for use? That's the cost of the asset. So we're going to look at that in detail today. I'm going to come back to these two issues of revenue expenditure and capital expenditure when a future slide talks about this in more detail. It's a little bit too early to talk about it now. Let's talk about the asset accounts. Land is an asset account. It is the quintessential property in property, plant, and equipment. It's real property, land. So what's the cost of the land? It's not just the cash price of the land. Okay. First, there's closing costs. So in other words, land is real property. It needs to be recorded. All real property like land and buildings are recorded with the government, and the government recognizes your ownership by issuing you a title, right? So it's official ownership. All of that takes a little bit of money to do, and attorney's fees are often part of that. So closing costs are part of that because you need to pay it in order to get the land. If you're buying a piece of land, you're probably buying it from someone who's represented by a broker. Heck, you could be represented by a broker. And brokers don't work for nothing. They work for commission on the sale of property. So there's real estate commissions that you'd have to pay as part of that. On occasion, there may be land that has certain issues, creditors that need to be paid, such as back taxes or other types of liens, which are legal rights to collect a debt. And so you have to make sure all those are taken care of first. And that's usually what happens that you have to do to get it ready for use. However, sometimes you might buy land that's got junk on it. Well, what I mean by junk, could be a very old, dilapidated building might be on it. It might be foundations of buildings that used to be there, but they've gone away. But the foundation is there. Um, what you might need to do is take all that out in order to get it ready for use. So if you have to do that to get the land ready for use, all of that cost is part of the land account. Okay. So the first thing we're going to be doing is, can you calculate the cost of this asset? And for land, again, this company is a manufacturing company. They acquire land for $100,000. There was an old warehouse on that land, which they raised. Now, to raise is simply to take down, clear away. That cost them a net of $6,000. They had an attorney's fee they had to pay. They had a commission. So what is the cost of the land? In this case, it's going to be all of these things, because all of these things are necessary to get the land ready for use. And so $115,000 would be the true cost of the land, the way we see it in accounting. Things that are on the land that are not that's not a building is something called a land improvement. What do we mean by that? Well, parking lots, fencing, landscaping, things like this. They are put on the land, but they're not land itself. So literally, land improvements is an asset account that you haven't heard of until today. So land improvements, again, asset account. So again, the interesting thing with land improvements is if you think about a parking lot or a fence, they're not going to last forever. Land is always going to be around. Just check out the planet. We've been around for a while. So land, we're assuming, is going to be good forever. But anything on the land has a what we call a useful life. And what we mean by useful life, we're not trying to degrade anything here. We're trying to say, from a business perspective, how long can I use it before I got to replace it? That's a useful life. So parking lots, as you know, they get cracked, they get chipped, they fall apart. Um, they don't last forever. They might last a long time. They might last 10 or 15 years. I don't know personally, but they need to be replaced. Fencing, other types of things. They look good at first. They last several years or more, but then again, they're going to need to be replaced. So that period of time is its useful life. Now, because we're spending money to put in a parking lot or put up a fence, etc., for the purposes of doing business, and we know we're going to need to replace it over a period of time, the cost that we spent to put these things up can be subject to what we call depreciation. We can start allocating the cost of that slowly. Again, in accounting for any type of asset, you have to use it before you can expense it. So you remember supplies is an asset, but after we use it, we expense it. You remember prepaid insurance is an asset, and after we use it, we can expense it, right? And those things that we use very quickly. Supplies run out quickly every month. We use up a month of insurance, so we're going to have those expenses quite quickly. Um, Parking lots last a long time. So the process is different. 10 years, you can't just expense it all in 1 month. You're going to expense it very slowly over the course of its useful life, over that 10-year period, for example. So that's what depreciation is about. And that's what you're going to be learning about as well. So again, land improvements, a new account. Amen. Hallelujah. See, you're growing. The buildings account is also an asset account. And here for buildings, there are two options. We can either buy an existing building or we can put up a building where there is none right now. So a couple of options there. For buying an existing building, yes, we're going to need to pay a certain price. It's real property, so it's going to go through that closing costs, its titles and other things that are involved, and real estate broker's commission. All that's true. However, before you can use a building, remember the ready for use standard is important. Before you can open up and use a building, it needs to be up to code, it needs to be up to appropriate building code, et cetera. So that means that it might need to be remodeled in some way. You might need to repair or replace the plumbing, the electrical, the roof, the floors, et cetera. All these things have to be up to code before you can actually use the building. So any money you spend getting the building up to code so you can use it is applied as the cost of the building to get it ready for use. Okay. So that's if you buy an existing building. If there's no building there and you want to put one up, you're going to have to hire an architectural firm to design and your building accordingly. You can't put up a building without having all types of permits granted, and those cost money. So that's necessary. And then, of course, depending on where your building is, you are probably going to need to dig a little bit. So there's going to be excavation costs to make sure your building is properly your foundation is properly done. And in some cases, like I said, there's a little bit of digging to do. In some cases, there's a lot of digging to do because in cities, you get those skyscrapers, et cetera. They have to be embedded in the bedrock of the earth so they don't move. Um, so that's an important type of thing. So that can be, and of course, you're going to put the building up. So all those are going to be part of the cost of the building. Everything that you need to get the building ready for use. Equipment is a very important account. Most businesses have equipment. Uh, Equipment it ranges. Equipment for like on my Wendy's or pizzeria examples, the refrigeration system, the stoves, the fryers, the pizza ovens, the frosty machines. All of that is equipment, but also, you know, it can go on and on, right? So again, when you are, some businesses are small, they'll throw things like their delivery trucks in the equipment account. Larger businesses have a separate vehicles account for that. So UPS would probably have its own separate vehicles account for all its delivery trucks, for example. But equipment can be a good catch-all for a lot of small businesses. And again, the cost of equipment is everything to get it ready for use. So you have to pay for the equipment. There's a cash price. Most of the time, there are taxes, sales taxes on equipment to manufacture a product. And so often states that have sales taxes will apply a tax on the equipment. You're probably buying the equipment if it's specialized equipment from someone else. Could be in the state, could be across the country, could be around the world. So there's probably going to be some freight and insurance charges to get it to you. Once it does get to you, it has to be assembled. You might need to do some special installation. You might need to do some testing. You might even need to train, if it's a new piece of equipment, you might need to train workers how to use the equipment. Everything that you need to do to get it ready for use is part of the cost of the equipment. That's how we look at it. Okay.
Uh, for big businesses like UPS, do they break the accounts down into regions?
No, not for the assets. I mean, they don't, not for assets. No, no. I mean, it's all one. Vehicles are vehicles.
So all across the world would be in one big total account?
Um, I wouldn't say that. I think that again, um, they would eventually come together in one big account, yes. But if there's a separate part of the business that's keeping records for that area, it'll eventually merge into what we call an aggregate or a total. So yes. So let's get to our cost here for Leonard. They bought a delivery truck for $22,000 in this case. We had to pay $1,320 in sales taxes on that truck. We painted it and put letters on it for $500. We paid $80 for a motor vehicle license, and we bought insurance for $1,600. What's the cost of the truck? Well, we had to pay the cash price of the truck. We had to pay the sales tax on the truck. Mostly, if businesses get trucks, you know that they paint them their particular UPS. You're not going to see a UPS truck that's not painted. It's brown with their gold UPS thing lettering on it before they can use it. Optimum has their little trucks. They all are painted different colors with Optimum on it. This is very common business practice. Before you use an asset, you want it to be painted. It just reflects a lot better on the business than if you just sent some like general truck out to someplace. This doesn't look as good. So all of those would be part of the cost of the truck to get the truck ready for use. The license doesn't get the truck ready to use for use. It gets the driver ready to use the truck. So the license simply here is an expense for the company because they're preparing their employee to use the equipment. They're not preparing the truck to get used. And every time you buy insurance, as you know, by now it's prepaid insurance. So although we're going to be spending $25,500 on all of this, only $23,820 is going to be the cost of the truck. Like I said, the license will be expensed, and prepaid insurance has its own account anytime we buy insurance. All right, so I'm going to go back to the earlier slide that had what we call revenue expenditures and capital expenditures on it. They relate to this. Even when you buy a truck, you know that even if its useful life is going to be 5 years, UPS uses their trucks all the time, so they really burn them out. They know that they need to change the oil, they need to change filters, they need to change the tires. There's certain things that are required to do as ordinary repairs. Okay. Um, That simply gets debited into an expense account when they do it. So maintenance and repairs expense is simply for ordinary repairs, just to make sure the equipment is running the way it's supposed to. No one buys a piece of equipment knowing that I expect it to last 5 years and I need to do nothing for 5 years. No one thinks that. It's unreasonable. There's always maintenance to do, and those are simply expensed as you do it. However, some things that you do to equipment might actually increase its useful life. So let's go back to our UPS truck. We've been using it for a couple of years. And during the third year, we had to overhaul the engine. Now, when you overhaul an engine, you basically give the truck a new engine. So if you have a new engine, you've literally can use the truck longer than you expected, right? Because that new engine is really what's driving the truck. Thus, you've increased the useful life of the truck by putting in a new engine. So that's an addition. That's called an addition and improvement. And in those cases, we actually debit the asset account itself, okay, because we've simply increased its useful life. So that's important to know. Also, what's important to know is a lot of companies will lease a lot of their property, plant, and equipment. That's their. They'll buy it outright. Other times they'll lease it. So with a lease, leases tend to be longer term, 2, 3, 4 years. Those vehicles or property technically are assets to the company. However, the lease itself represents a liability to the company, and they, in essence, cancel each other out. So oftentimes, leased equipment is not reported on the balance sheet. You will not see it on the balance sheet. You will see it in the notes to financial statements telling you that they have indeed leased certain amount of equipment. And again, the story in the book shows many, many companies use leases. And interesting enough, with leased airplanes, 40% of the US fleet is leased. Okay, so this is a big, big things that are done. So, and again, whether a lot of companies like Marriott lease their hotels, they don't own the buildings. So there are certain things that you have to think about when it comes to leases. It's your property to use, but then because you owe an equal amount, a lot of businesses don't even put them on the balance sheet, but they do need to note them. Okay, so part one, learning objective one, understanding how to calculate the costs of an asset. That's the whole purpose of that. You'll have homework on that. Learning objective two focuses on depreciation. So like I said, when you have an asset, when you're buying property, plant, and equipment, you're going to think, how long is it reasonable to use this equipment or this building or this property before you need to replace it? Okay, because everything needs to be replaced at some point in time except land. Land does not need to be replaced, but everything on the land will need to be replaced. Some equipment only lasts 2, 3, 4 years. Um, some equipment might last 20 years. Buildings might last 20, 30, 40 years. In any way, shape, or form you look at it, they have a useful life. Because they have a useful life, we can start allocating part of the cost of that asset. That's what depreciation is. So depreciation technically is a way to allocate the costs of these assets that help us really generate revenue, okay, for the company. So those pizza ovens that I have in my pizzeria are helping me generate revenue. That's how I cook my pizzas. That's how I cook my my subs or heroes or whatever you call them, my sandwiches. It's helping me produce revenue. At one point in time, I'm going to need to replace it. Okay, so so because it's helping me produce revenue, depreciation is looked at as part of an expense to sort of match that up. Okay, depreciation has a few factors that you have to know. The first factor we've already learned in learning objective 1, right? What is the cost of the asset? And that's what we just looked at earlier. You already kind of know how to calculate costs of property, plant, and equipment. You've already heard of the idea of a useful life. And again, how long will the business be able to use this asset before it needs to be replaced? Okay. What you haven't heard is the third thing. Once we are done using the asset, will it have what we call any salvage value? Okay. At the end of its useful life, will there be any salvage value, any value left in that asset? For some assets, no. Okay, there'll be zero salvage value. No one wants, there's no real market for a 4 or 5 year old computer system. No, zero. However, for a truck that's listed here, it's quite possible that when you're done using it, even though it's going to be lots of miles on it, etc., it may have a small value. That's a salvage value. That's really all we're talking about. Okay. For depreciation methods, there are a few of them, but the winner overwhelmingly is something called straight line depreciation. 83% of companies use it. It is clearly the most important one to know. So this is the only one that you're going to be focused on here. There are other ways to depreciate, including something called declining balance, which is a nice way of saying accelerating depreciation. So this is an accelerated depreciation method. And the straight line method measures useful life in years. That's important to know. However, you can actually measure a useful life in something called units instead. So, for example, if I think I'm going to have a truck for 5 years, that's the years. But I can also say I'm going to use that truck for 200,000 miles. That's a unit per mile. I can depreciate per mile. It's a pain in the butt to do all of that. It's just a lot easier to do it by years. So not only is this the easiest method to do, it's also the one that's required by the IRS to do your taxes. So most businesses simply just use straight line because it's both the easiest and the most practical one to do. So how does it work? Here's an illustration. It's quite easy. Here we have Bill's Pizza. They purchased a small delivery truck. Yeah, I can see it's very small, 13,000. I haven't seen a lot of trucks that are 13,000. What does it have? Do you have to wind it up in the back to get it going? I'm not really sure. You pull a string and it starts going? I'm not sure. But it's a pretty small truck for 13,000. That's the cost. That's, again, from learning objective 1, how much did it cost them? They are expecting to use it for 5 years. That's the useful life, right? It's useful life. At the end of the 5 years, they believe it's going to have a salvage value of $1,000. Okay. If they used units, they would break it into miles. Since we're not doing units, we can ignore that. Okay. So this is the important piece of information: the cost, the salvage value, the number of years we're going to be using it. Okay. Those are the information you need to do straight line depreciation. That's all you need. And this is how it works. Okay. Straight line method basically breaks the expense into the same amount every year. And it's based on how much you are going to use of the asset. So what you're going to use is the difference between the cost of the asset and the salvage value of the asset. The difference is what you're going to use. So that's called the depreciable cost. So here we have a $13,000 truck. That's the cost of the truck. After we're done using it, we think it's going to have a salvage value of 1,000. So we're going to use the difference for the business. See? So because we're using this amount of this asset for the business, this is the only thing that can be expensed through depreciation. We take the $12,000 that we're going to use from this truck, divided by the years. So every year, literally, we will depreciate $2,400 a year as depreciation expense for this truck. Okay, that's basically how to calculate straight line. Very Very straightforward. Okay. How it works in a bigger illustration. Again, here's the 5-year period that they're going to use the truck. We're assuming they bought it in early of 2017. They're using it for 5 full years, all the way down to 2021. They can depreciate $12,000 of the truck. Okay. Over a 5-year period means that they're going to allocate 20% of that every year to depreciation. Okay. 20% of this is $2,400. Okay. So the annual expense at the end of every year, this is an adjusting entry. At the end of every year, they'll have a depreciation expense for $2,400, and accumulated depreciation will get a credit. This is for the equipment for $2,400. So as you know, expenses are closed at the end of the year. So every year you put this expense, it's going to be the same. However, accumulated depreciation is an asset account. It does not close. So you see, after every year you have expensed it, it accumulates. This is, in essence, an accumulation of the expenses. So after the first year, only $2,400 is accumulated. But after you've expensed it for 2 years, 2 years of these expenses, you've now expensed $4,800. That's what's accumulated. After the third year, again, each year you're expensing $2,400. It's now accumulated to $7,200. So every year you expense, it accumulates. Notice you cannot accumulate more than the $12,000 that you said you were going to depreciate. So the accumulated depreciation is going to accumulate all the way to the total cost that you said you were going to depreciate, $12,000. Another thing to know is something called book value. Book value is simply the cost of an asset minus the accumulated depreciation of an asset. Okay, it's going to be your book value. So remember, this truck cost them $13,000. That's the cost. We simply subtract out the accumulated depreciation to get the book value. So a $13,000 truck, after the first year, we subtract out $2,400 of accumulated depreciation. It'll have a book value of $10,600. After the second year, we have accumulated $4,800 of depreciation. The book value is dropped to $8,200, right? All the way down to the salvage value. You cannot go below the salvage value on the book value, okay? Because that's how much you said you can write off. You're going to write off $12,000. That brings your book value to $1,000. Period. That's the most you can do on this truck. A lot of people ask, well, can Bill use the truck in 2022? Sure, he can use the truck in 2022 if he wants to. He can't expense it anymore. He's done expensing it, but he can use it if he wants to. Amen. Hallelujah. Good for Bill. Okay. The only thing that comes into play here with straight line depreciation is, again, the straight line method calculates the yearly expense, right? The annual expense means all 12 months. What if he bought it in April? So for 2017, he's only using it for 9 months. So thus, for the very first year, he only had it for 9 months. Even though it has an annual depreciation of $2,400, that's for 12 months, he can only write off 9 months in the first year. Okay. What about those other 3 months? Just tack it on at the end. So if you notice, this 9 months plus these 3 months is 1 year. 2 years, 3 years, 4 years, 5 years. So he's still getting a full 5 years of depreciation on the truck. He just has to split it up in the first year if he didn't purchase it in January, because you got to use it all 12 months. The remaining part, you can write off after. Okay, so that's going to be the only difference with a partial year. Now, there are choices, just like, remember, we did our inventory chapters where management can choose between FIFO, LIFO, average cost, right? You all know that. Same thing with depreciation. They can choose between straight line, declining balance, units of activity. It's their choice. But notice, if regardless what choice Bill chooses, you can only write off the $12,000 of depreciable cost that you calculate. You can't write off more than that. Okay. Straight line, you already know it's the same expense every year. Declining balance is accelerated. As you see, most of the depreciation is accelerated to the early years. That's why it's called an accelerated. You're expensing it early. Most of it is expense in the early years. Very little is expense in the later years. Units of activity is based on miles. The more you drive it, the more miles you've used that year, the more your expenses. The less you drive it, the less your expense is going to be that year. It's a pain in the butt to keep track of all those miles, but you can do it that way. But you're still stuck. You cannot go past the 12,000 regardless what method you use. Okay, just to know that. But again, straight line is the most popular. It's the one that you need to know. The IRS requires straight line, which is why so many businesses do it. Not only is it easy to figure out, it's going to be easier for your taxes. Do you have to use it for your taxes? No, because the IRS actually has its own depreciation system as well, called MACRS, the Modified Accelerated Cost Recovery System. But this is a tax issue. This is a tax system. It's not a reporting system. So under GAAP, remember, generally accepted accounting principles, these are the rules we're learning. You can't use MACRS. You have to use straight line or one of the other ones. All companies have to note what they use. So here we have Southwest Airlines. They use the straight line method. Okay. They have useful lives of 23 to 25 years for their flight equipment and between 5 and 30 years for their ground equipment. So that's important. Of course, they'll list more detail, and this is just like a short blip. But it is interesting. They have to disclose that in the notes. Okay. One quick thing here that's important to know is sometimes there's a permanent decline in the fair value of an asset, and that has to be reported as an impairment. So what do we mean? I'll go to a lot of people who have Robinhood are hooked on Aurora Cannabis. It's a cannabis company in Canada. A couple of years ago, Aurora went on a buying spree. They thought the market was ready to boom. And so they purchased a whole bunch of facilities, buildings in which they grow pot. However, they were expecting those buildings to be filled with pot plants and they can sell all of it. That never materialized. So in essence, they had a bunch of buildings that they weren't able to utilize. They didn't have the value the company said they had. They had to write it down as an impairment. Okay, so basically, it's a write down of an asset to its new value because things didn't work out the way they had planned. And that is our lesson today. Okay, so 2 things to remember. The cost issue is learning objective 1, how to calculate the cost of an asset. Learning objective 2 is about depreciation, and you got to focus in on that straight line depreciation. That's the most important. How'd that go?